Very good morning to all our listeners. Hope you all had a great weekend. A quick recap in Asia. One of the major stories there was the fact that the Chinese central bank have indeed cut the reserve requirement ratio, as was highly speculated in the last week or two, by 50 basis points. The Shanghai Composite, though, failing to have any sustained reaction and did close in minor negative territory. The real focus, though, here in Europe has been on the fact that Greece has failed to form a coalition at the weekend, and as such equity markets in Europe have traded firmly to the downside, weighed upon mainly by the financial stocks. In particular, Spain has been in focus. Their domestic 10-year bond yield has now crept back up to 6.2%, and the spread over benchmark bonds in both Spain and Italy is roughly around 30 basis points wider at the moment. That has prompted risk-averse trade across the board, a general flight to quality in the 10-year fixed income futures. The euro is a little softer in the currency markets, and respectively the dollar a little stronger, which has weighed upon both crude futures and gold and silver prices this morning. So basic materials also seen a little softer in the equity space. Looking forward then in terms of the calendar, with a lack of real tier 1 data coming out of the US, then focus very much remains on the situation in Greece. In terms of the Eurozone itself, we seem to have settled, at least for the time being, a little bit of that opening nervousness, given the fact that the Spanish T-bills and BTP auctions coming out of Italy managed to fulfill the top end of their indicative ranges. But with the failure to form a coalition at the weekend, and with the US players yet to come in the market, that will likely take precedence, with a lot of downbeat commentary out of various European publications still talking about a potential for a Greek exit going forward. That pretty much though concludes the opening wrap here in London, so I wish you all a great trading day.